The onshoring of the supply chain story focused on those bigger names at first, right? You know, Nvidia was very aggressive to point out all of its capital commitments to this nation and taking the first Arizona-produced chips from TSMC. That's been in the headlines. But do you see evidence that there is opportunity for investors to invest into something being built out in America that goes beyond an Nvidia?
Yes, I would say in general, the onshoring process will take years in terms of truly domesticating our supply chains. That will take years, and that's not actually my central focus. My central focus can be best encapsulated by the fact that Nvidia, they're having one of their biggest product moments ever, which is a huge statement. As you know, I've covered this stock very closely for many years. They have Blackwell Ultra shipping, but they're moving from 8 GPUs to 72 GPUs, and that's that piece that I'm explaining is a big moment for Nvidia. What that means is that the supply chain should erupt in the upcoming quarter and the next quarter because that complexity has just gone up 9x. So I'm very, very focused there, less on timing of onshoring this manufacturing.
Right. I'm going to be in Washington, D.C. next week for GTC DC, the second edition of the year of GTC. When those kinds of events happen, how high is the bar for Nvidia to come out and say something on the product or technology side that moves the needle for investors?
Yeah, I guess I'll be a contrarian again, and I will say,
Please.
if Nvidia can give us more on Rubin, knowing that Blackwell Ultra shipping, they're shipping in volume, I'm very positioned for that. Anything forward-looking for Nvidia at this point, let's just say we have this conversation this time next year, I would want to hear more about Rubin, which may actually come more in March.
The big news story of, I suppose, the last 24 hours beyond the AWS outage, which I don't know how that impacted you, has been rare earths. You know, the specific headline, an American deal with Australia, which is kind of being interpreted as this countenance to what China is using as levers in the negotiation. How do you look at the markets in the moment and how they're reacting to rare earths and the news flow of the day?
I certainly would have loved to have owned some of those rare earth stocks. Some are up, almost 400% this year. Look, China's using it as a bargaining chip in response to us restricting our excellent design companies. These two economies have battled it out for decades. And so even though these things are important to track, we are so interdependent at this time with China and other regions that I don't think it's something that you would exit AI stocks for. If anything, I would just look at this as many global powers are concerned about how are we going to keep up the manufacturing because demand is so high. Demand is outstripping supply. That piece is much more important to me as an investor than all the little nuances as to how we get there on supply.
You use the phrase bargaining chip. I'll pardon the pun on your behalf, but the calculus for people like David Sachs is that is the negotiation. Rare earths on the China side in exchange for access to deprecated chips on the US side, and principally Nvidia deprecated chips, right? Do you have a better sense, Beth, of where that negotiation is heading?
I could see it being resolved favorably for both sides. We've heard from Nvidia's CEO that he would really like to restore those relations. So even if you take some of our industry leaders, they all want to see, as much working together as possible. Of course, is that reasonable? I do think that geopolitically, AI will continue to be a point of tension. It is just so powerful in terms of what it can do for GDP. And I think it just goes back to that piece, which is because it's so powerful as to how it can grow GDP, it's a really the best investable opportunity of our lifetime. And that's the piece I would really focus on.
Over the last 3 years, Nvidia stock has increased by more than 1,400%. For a large portion of the hardware used in AI development, Nvidia is the preferred supplier. The semiconductor industry could benefit financially from the quick expansion of new data centers. One of the biggest winners from the recent explosion in artificial intelligence, AI, during the last few years has been Nvidia. Its stock has risen more than 400% in just 3 years, outpacing the 79% gain in the S&P 500 index. Although Nvidia's performance has clearly benefited current shareholders, individuals who are currently seeking to purchase the stock still have opportunities. The anticipated expansion of AI infrastructure and Nvidia's contribution to it are the main reasons it may continue to rise in the long run. Since data centers are essential to AI training and scaling, several well-known businesses are constructing new ones. Since Nvidia is the foundation of these facilities, these additional build-outs naturally benefit it. They contain the software platforms, networking devices, and GPUs from Nvidia. For many pieces of hardware used in AI development, it is the preferred option. During the latest earnings call, CEO Jensen Huang asserted that Nvidia is obtaining a $35 billion revenue share of each gigawatt AI data center, which has a cost of between $50 billion and $60 billion. This explains why Nvidia's data center revenue, which accounted for more than 88% of overall sales in its most recent fiscal quarter, increased 56% year-over-year to $41.1 billion. Nvidia's earnings growth will continue as long as tech businesses keep investing in AI infrastructure. Although a slowdown in year-over-year growth is to be expected, this does not negate its potential to remain a major player in the industry. Because Nvidia's stock is expensive, if you're concerned about any unexpected declines or corrections, consider dollar-cost averaging your way into a holding rather than making a one-time investment. As big tech earnings are expected to be released on Tuesday, Nvidia's shares fell but managed to hold a crucial level. The recent statement by Nvidia CEO Jensen Huang that demand for the company's Blackwell graphics processing units is really, really high gave a boost to the larger AI industry. Should I buy or sell Nvidia stock right now? According to market research firm DataTrek, Nvidia controls 34% of the S&P 500 together with other Magnificent Seven members. According to Nicholas Colas, co-founder of DataTrek, the S&P 493 should begin to catch up in the first quarter of 2026, but big tech will demonstrate significantly stronger profits growth over the next 4 quarters. Tesla is the Magnificent Seven company with the most anticipated earnings on Wednesday. Alphabet, Microsoft, and Meta will all disclose their results on October 29th. On Thursday, Apple comes next. Nvidia's fiscal third quarter report is scheduled to be released on November 19th. Bank of America has expressed even greater optimism about the chip industry. As the demand for AI gear continues to soar, the company now projects that global semiconductor sales will reach over $1 trillion by 2027, significantly exceeding its initial projection of $860 billion. The improvement, according to analysts, is the result of greater growth in data center components and memory chips like HBM, DRAM, and NAND, although consumer and vehicle demand is still a little weaker. According to the bank, industry sales would increase by roughly 3% to 6% to $745 billion in 2025, $870 billion in 2026, and $971 billion in 2027. Its top picks include Nvidia, AMD, Broadcom, Lam Research, and KLA Corp., all of which are viewed as major winners from the surge in data center and AI spending. Moreover, BofA increased its investment prediction for semiconductor equipment to $118 billion in 2025 and up to $138 billion by 2027, pointing out that production complexity is raising long-term capital intensity. According to analysts, the AI rollout is structurally more robust than previous innovation cycles, suggesting that the boom may last. The more artificial intelligence, the better in the current market, when everyone is obsessed with technology equities. Even if it's as short-lived as a partnership announcement in the news or a company name change that incorporates AI into the new moniker. As one of the smallest components of the S&P 500, energy equities are historically volatile. Let us be starkly reminded of this. Not many of us can even entertain the idea that tech stocks, much alone the venerable Nvidia, would eventually be reduced to the same size as XOM in the capitalization-weighted index. After dominating the market cap mountain for 12 years, the oil and gas behemoth now accounts for 0.84% of the S&P 500 SPDR ETF. In addition to holding 8% of the SPY, Nvidia is just under 10% of the Nasdaq 100 index. The degree of correlation between the two main stock market trackers is mostly responsible for that. Furthermore, even while this might not be a problem today, I believe it will be at some point in the not-too-distant future. Perception has a role, as does a pervasive misconception. All of this raises the possibility of violating the fundamental investment principle of know what you own, because only then will you be able to comprehend and identify the dangers you are facing on each trading day. Investors may mistakenly believe they are well diversified if they notice that the majority or all of their 401k plan investments are in S&P 500 funds. 500 stocks is a lot. In case a stock here or there fails us, we have plenty of backups. Not at all. Since the majority of the S&P 500 stocks don't affect the index. Just have a look at the list of the top S&P 500 holdings above. The index would lose less than 1% if XOM actually plummeted to zero in a single day, while the rest of the market broke even. Because a 100% loss on a holding of 0.84% equals a loss of 0.84%, Nvidia would see the same effect if its stock fell 12% in a single day. Although that is also outside of the typical range, keep in mind that the stock dropped 17% in a single day in January of last year. And on a single day last week, it dropped by over 4%. On Tuesday, October 14th, during the daily trading session, Nvidia had a 4.4% decline. About 8% of the S&P 500 index is made up of it. When you add them all together, you can see that Nvidia had a 0.36% negative effect on the S&P 500 on that particular day. The index as a whole fell 0.12%. In other words, the S&P 500 would have increased by 0.24% if Nvidia hadn't been involved. Yes, these are merely quick mathematical computations. The message is still clear, though. A single firm that accounts for 8% of the most closely watched index in stock market history is cause for concern. There is more to it than just numbers. It also has to do with the possibility that investors would make choices based on incomplete information. Indeed, the information is there and simple to locate. It might not be evident, though. One of the main winners of the quick growth of the global AI infrastructure is Nvidia. Nvidia's main advantages are its full-stack AI platform and yearly product cadence. The revolution in artificial intelligence, AI, is currently moving from pilot studies to practical implementations. The need for AI infrastructure is growing at a never-before-seen rate, which is not surprising. In response, hyperscalers are spending billions on the construction and expansion of data centers. The main winner of this chance is Nvidia. Here's why long-term investors may find them to be excellent choices. Nvidia has been solidifying its place in the AI infrastructure market at a quick pace. The business has partnered with Microsoft, xAI, and BlackRock to purchase aligned data centers for $40 billion. As hyperscalers and sovereigns make significant investments in data center expansions, the acquisition underscores the enormous demand for computational capacity. The global deployment of AI infrastructure already heavily relies on Nvidia's GPUs, CUDA software and developer tools, and networking solutions. By 2030, management projects that the market for AI infrastructure would have grown to a value of $3 trillion to $4 trillion. In 2025, it is anticipated that about $600 billion would be allocated to computing and data center infrastructure. The company's revenues climbed 56% year over year to $46.7 billion in the second quarter of fiscal 2026, which concluded on July 27, 2025. At the same time, non-GAAP adjusted gross margins achieved a remarkable 72.7%. Due to the strong demand for Blackwell architecture chips, the data center industry is the main driver of growth. Wedbush channel checks conducted throughout Asia revealed that the Blackwell chip supply-to-demand ratio was almost 10 to 1. Many hyperscalers have found that switching from the Blackwell architecture-based GB200 system to the next-generation GB300 system has gone smoothly because the two systems share design, software, and physical dimensions. With factories putting together about 1,000 racks of fully integrated AI systems made up of GPUs, interconnects, and switches per week, Nvidia has already started full production of GB300 systems. According to management, CoreWeave observed that GB300 systems outperformed earlier Hopper generation H100 chips by a factor of 10 in inference performance on reasoning models. According to tokens per watt, the GB300 NVL72 system, rack scale system, which unites 72 Blackwell Ultra GPUs with NVLink 72 ultra-high bandwidth interconnects, is likewise 10 times more energy efficient than Hopper chips. This is turning out to be a crucial differentiator for Nvidia, particularly given the record-breaking rate of growth in data center power needs. A loyal client base has also been cultivated by Nvidia's yearly product cadence, which releases new architectures every year. Clients may decide not to switch to the competition, since they can easily upgrade to the newest cutting-edge GPU technology with minimal impact on their business operations. Nvidia is currently preparing to start producing the next-generation Rubin GPUs in large quantities in 2026. Another important development engine is networking. The company's networking sales increased 98% year-over-year to $7.3 billion in the second quarter. Spectrum X Ethernet, the company's AI-optimized Ethernet networking technology, is likewise gaining traction quickly and, as of the second quarter, has reached the $10 billion annual run rate. At the moment, Nvidia's price is 28 times its projected earnings. Nonetheless, given its leading position in AI computation, yearly product cadence, and growing power in AI networking, the valuation appears to be warranted. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.